Today is the 16th anniversary of the terrorism act on the World Trade Center, commonly known as 9/11, 11th of September 2001, where over 3,000 people in New York were murdered by Islamic fundamental terrorists. Today apparently is called Patriot Day, which I had never heard of. Can someone tell me, because no one has been prepared to answer this question in the mainstream media or in politics and so on, and yet it's blindingly obvious a question. Why on earth was a Saudi Arabian financed terrorist act, the biggest terrorist act in American history, followed by an attack by the Americans and the Brits, etc., on Afghanistan? I'll never understand that. There are many questions there. Of course, one assumes it's to do with the petrodollar. There's stuff to talk about that point, actually, in due course. But it's just frightening what goes on in the real world that is patently obvious, but somehow they get away with it. In any case, welcome to the Booms and Busts show. Good morning, good evening, good afternoon, wherever you are. My name is Jonathan Davis. Today is indeed Monday, the 11th of September 2017. The Booms and Busts show is where we talk about free market capitalism, avowedly against cronyism and socialism, and we talk a bit about politics as well from a libertarian bent. This week's show is going to be slightly different because I've got two or three topics in particular that I want to focus on, and one of them is actually quite complex, about complex economic thinking. So I'm going to focus on a few detailed areas as opposed to often the shows perhaps cover 8 or 10 different topics. I'm going to be looking at the Federal Reserve of the United States, obviously the most important central bank on the planet. I'm going to be looking at Trump's influence on that over the next year and a half. I will be talking about some economics and markets. In particular, I'm going to focus on some major changes in markets that I'm seeing big picture and also small picture. And that's what we're going to be talking about. Welcome again to the show. If you want to tweet me, please do so at Booms Busts Show. Email me at jd@theboomsandbustsshow.com, jd@theboomsandbustsshow.com. A number of you have contacted me over the last week to request to be put on the mailing list for the Booms and Busts report. Delighted to do so. In fact, I've sent them the Booms and Busts reports that I produced already this year. I hope that they found them interesting and indeed possibly useful. If you want to receive the Booms and Busts report, which puts a lot of meat on the bones of what we talk about here, and with particular reference to developing your retirement funds, in other words, in investing strategies, then just send me an email or direct message me on Twitter. Let me start with the Federal Reserve And I'm prompted to talk about this because last week, the most corrupt central banker with the biggest ego and narcissism on the planet resigned. He'll still be in situ for some months, but he's giving up significantly earlier than he said he was going to. I'm talking about Stanley Fischer, the Vice Chairman of the Federal Reserve. Why do I call him the biggest ego and narcissist on the planet? Well, let's go into a little bit of economic theory and history. Professor Fischer, because, that's how he started out as an academic who was brilliant at passing and getting A+ grades, was for more than 20 years professor at the MIT, where he influenced generations of economists. I'll come back to that in a moment. He has been the first deputy managing director of the IMF. He was a chief economist at the World Bank. And for a short time, he made tens of millions in the space of just a few years working at Citigroup, which is just about the largest banking group in America. He became a vice chairman. Now think about this, from decades as an academic, and then he went into the bureaucracy of public sector global banking. Isn't it funny? He then went into Wall Street for a handful of years and made tens of millions. Think about that. He was also the head of the Bank of Israel from 2005 to 2013, where he was poached to join the Federal Reserve as vice chairman. He's been there 4 years. The guy's retiring. He's retiring early. So let's look at some background. When Professor Fischer published his famous paper, because that's what academics do, they publish papers. And when academics go to conferences to talk about what they've written to an audience of 3 academics that, of course, they've had to fly business class for 5,000 miles at the expense of the taxpayer to talk to these 3 people. Do you know what the academics call that? They call it talking to your paper. This is their world. They don't speak English, or the English that they speak. You have to be so ingrained with 6-syllable words to understand their language. So when he published his famous paper called On Activist Monetary Policy with Rational Expectations in April 1979, the fiat money world, and let me remind you, fiat means a currency based on a promise as opposed to backed by a hard asset such as, of course, gold. The fiat money world was well into yet another stage of disorder. Huge inflation, huge interest rates, so on. But things were at a temporary resting point where the skies seemed to be getting clearer. Late 70s, early 80s. After the violent terminal storms of the gold exchange standard, from the early 20s to the early 30s, and then of the Bretton Woods system 1944, which set the US dollar as the replacement for sterling as the global reserve currency, it seemed to many that the, quote, monetarist revolutionaries, unquote, had found a useful practical monetary navigation route. the Bundesbank, the Federal Reserve, the Swiss National Bank, the Bank of Japan were pursuing a sort of golden rule of low percentage increases in the monetary base. Despite the general optimism, Professor Fisher issued a challenge. The monetarist rules, which were that you should have only X% growth of the chosen monetary aggregate, were doomed to fail when the underlying demand was so volatile. In other words, there were still busts. Well, of course there were. It's called capitalism. The Keynesian economists of the previous decade, so, the late 60s into the late 70s, based their practices on a view that central bankers could take the public by surprise, who wouldn't realise what they were up to until later on. But once the public knew what was going on, all Keynesian manipulations couldn't work. In contrast, Fisher purported to demonstrate that if wages were rigid, most likely due to the existence of long-term contracts, what a crazy, ridiculous assumption, then monetary policy could stimulate the real economy. And so, get this, on the basis of his pioneering neo-Keynesian creed, he preached that central bankers could and should pursue activist, contra-cyclical strategies, especially when shocks were large and obvious. If you haven't yet got it, we're talking about, for example, the massive stimuli since 2008. But even before that as well. But we'll come to that. However, he also recognised, because he's not stupid. This guy's got a PhD and everything. That this fine-tuning of the economy had its dangers. Really? And could morph into a long-run rising inflation rate. And that reminds me, that's the third thing I want to talk to you about later. Long-run rising inflation. What a coincidence. Massive stimuli. Are we now getting long-run rising inflation? We'll come back to that. So he recommended that policy be bound by the setting of a low inflation target. Remind you of anything? Yeah, let's pump literally tens of trillions of money into the system and keep doing trillions year after year after year, but we'll set a 2% inflation target. Oh, by the way, UK CPI is about 3% and RPI, if they still talked about it, is 4%. Inflation target, my foot. These ideas were taken up and worked on by his leading disciples, students, including the previous chairman of the Federal Reserve, Ben S. Bernanke, and the current president of the European Central Bank, Mario Draghi. Stanley Fisher emphasized in his resignation letter the Fed's role in strengthening the US economy and financial system. Oh my God. He said, during my time on the Federal Reserve Board, the economy has continued to strengthen, providing millions of additional jobs for working Americans. Informed by the lessons of the recent financial crisis, 2008, we have built upon earlier steps to make the financial system stronger and more resilient, can you believe this? And better able to provide the credit, to make people more in debt, so vital to the prosperity of our country's households and businesses. How is it possible, Professor, to make you more prosperity when you got more debt? These people are absolutely off their head and should be thrown into a padded cell and the key chucked away. He was also the PhD thesis advisor to some of the genius partners at Long-Term Capital Management, which some of you will know blew apart. It was a $2 billion hedge fund. It blew apart in 1998 because of the Asian crisis. These guys made massive leveraged bets based upon the teachings of Professor Stanley Fischer, and their mathematical models said that they could only go bust once in 1 billion years. They were proven wrong. Did anyone listen? No. What did they do? They got the other banks to bail them out, because they said, if you don't bail out our $2 billion fund, it will be the end of civilization. $2 billion. That was in 1998. From that moment on, global bankers knew that they could push the boat out for as much as they wanted. They could pull the elastic for as much as they wanted and make enormous hay. And when the brown stuff hit the fan, they knew that they'd be bailed out by the taxpayers. In 1998, the banks themselves bailed out their own system. In 2008, the taxpayers and the taxpayers' children bailed out the bankers. Now, this is me just reiterating what Jim Rickards has been saying, and he rightly then goes on to say, well, you know, that was 1998, 2008, 2018. Wouldn't that be coincidental? And who's going to bail the central banks out? First it was LTCM, then it was the private banks. Who's going to bail the central banks out? We'll come to that another time. And as I say, it was Ben Bernanke and Mario Draghi who in 1 year alone printed $8,000 billion to bail out the system, and all that money went onto the global central banking balance sheet, which we all are responsible for. These guys are so egotistical and narcissistic. They lie through their teeth because they live in a billionaire's paradise. They eat the finest food, the finest cuisine. They drink the finest wines on the taxpayer. They're chauffeur driven everywhere. They are in super business class, whatever it's called, up in the skies. They are in 5, 6, 7-star hotels wherever they go. They are fated like rock stars. Power corrupts, and Washington power corrupts absolutely. One of the other members of the Federal Open Market Committee, Bill Dudley, William S. Dudley, who's the governor of the Federal Reserve of New York, he is one of the four horsemen of the apocalypse, along with the chairman, Janet Yellen, the vice chairman who's clearly about to go, Stanley Fischer, and the fourth one I can't immediately recall, but basically they are the ones we need to listen to with regards to what's going to happen to interest rates. And you know these dreadful hurricanes in Austin, Texas, in Miami, Florida, and in the Caribbean and so on. This is how these unbelievably pathetic, disgusting economists who are running the world for the benefit of the global banking cartel, this is what he said. The long-run effect of these disasters, unfortunately, is it actually lifts economic activity because you have to rebuild all the things that have been damaged by the storms. Quote, unquote. Now, some of you who have never thought about that will be thinking, well, what's wrong with that, Jonathan? I'll tell you what's wrong with it. It's total, utter balderdash. Read Henry Hazlitt, Economics in One Lesson. The greatest economics book ever. Written, I think, 1948. You can probably even download it free on the internet. You can certainly buy it in a second-hand bookshop or a charity shop. You don't have to spend 20 quid. You can get it for 2 quid or nothing. And he tells us in the first chapter that Bastiat told it in the 18th or 19th century, I can't remember, where you've got the baker whose windows are smashed in by a hooligan. And the crowd look at the windows and say, oh, that's terrible. But hey, the glazier's coming. He's going to make it all right. And look, the glazier's going to get paid. And someone's going to have to come and clean up the mess. So, the baker's going to be putting money into the economy. And that money that's in the economy can go and buy the glazier, perhaps a new piece of equipment, perhaps a new horse, perhaps something nice for the house. And the person that he buys the something nice for a house from, that goes in, and so on and so on. It's called velocity of money. But no one's thinking of the poor baker. He's now out of pocket. So you've got on one side, you've got the glazier spending money, but on the other side, you've got the baker who's lost a lot. It doesn't do the blindest benefit at all to the economy. And going back to Austin or Miami, just think of the devastation on the lives of the people there whose lives are so massively disrupted. Whether or not they've got insurance, which pays out, and we know about American insurance companies, we've all seen the Hollywood movies. The disruption, it may take years, if not decades, for their lives to get back into an even keel. And one of the rate setters for basically the world said that the long-run effect of these disasters is it actually lifts economic activity. This is what we're up against. Frightening. Now, I'm going to stick with the Federal Reserve because we have a unique circumstance. President Donald Trump has the opportunity to appoint more Board of Governors members of the Federal Open Market Committee system at any one time that since any president, since Woodrow Wilson, who launched the Fed in 1913. The Federal Reserve's Board of Governors is made up of 7 members, 7 appointees. They're appointed by the White House. So, of course, you get a majority with just 4. And it ultimately is the majority, of course. It's not a 2/3 majority, it's just a simple majority which sets the interest rate, which sets the quantitative easing amount, and all this nonsense. Currently, there are 3 vacancies on the board. 2 have been there for much of Obama's time because he expected to pass it on as a gift to his lovely friend Hillary Clinton. Trump is to fill these 3 spaces. Fisher has just announced his resignation. He'll go in several months. Now, currently there is one sole Republican on the board, Jay Powell. Now, because the other Fed governors under Obama were Democrats, he has been alone for many years in his sandbox. That could change. Trump could appoint 4 Republicans as well as Powell being there. That means if Trump were into sorting out the system, he could appoint 5 hard money Republicans at the Fed, making rate decisions within a few months. Donald Trump will be able to shape the Fed as he wants it. On top of that, the Federal Reserve Chairman, Janet Yellen's term is up in January, just 5 months from now. Whoever Trump appoints to replace her, the 5th appointment he'll have will be subject to Senate confirmation. Because that process takes time, that means the president will probably name Yellen's successor later this year. By the summer of next year, he should have, assuming he makes all the appointments, 6 placemen with a Republican already in situ. And finally, the 7th, Brainard, will be gone by next year. By January 2019, less than a year and a half from now, all 7 positions on the FOMC committee could be Trump appointed. Never in 100 years of the Fed has this happened. However, what did Trump do last week? He got an extension to the federal budget for 3 months by going into bed with the Democrats. And the Republicans are furious. Fact is, Trump is not draining any swamp. He's a property guy, for goodness sake. He loves low interest rates. He loves the idea of a weak dollar so that he can bring in inflation. So Trump was elected on a drain the swamp platform. He has done almost nothing. Almost literally nothing that I can see where he is draining the swamp. On the contrary, he is knee deep in it. He is up to his nose in it. And whatever else he does with the budget, with defense, with social welfare liabilities, with foreign affairs, with terrorism, with immigration, whatever, the wall. I tell you, listener, securing the currency is his primary job. If you secure the currency, then you can achieve whatever you want. And we will know within about 6 months what his true intentions are. One of these Keynesian, fascist, cronyist, communist FOMC members is Lael Brainard. She's calling, one of the 7 members, she's calling for more inflation analysis before there's any more raising of interest rates. It's funny how those things work, isn't it? Or don't work symmetrically. I didn't see a single person calling for a need for study on QE before launching it. Either QE 1, 2, or QE to the N. In a similar vein of what the establishment does, I see that Bremoners, changing the subject obviously to leaving the EU, Bremoners are worried about Parliament's scrutiny of secondary legislation. I noticed they were very quiet when governments transferred thousands of EU directives that way. Funny that, isn't it? I mentioned the Booms and Busts report earlier. I've just remembered, didn't mention the Booms and Busts Club, where we're going to get together to solve the world's problems over a beer and maybe a curry, that sort of thing. We're in Hartford, just north of London. Direct message me on Twitter, Booms Bust Show, or email me at jd@theboomsandbustshow.com and tell me that you'd like to come to the first meeting when we set it up. And I will let everyone know in plenty of time when the first meeting will be. So, let me know if you'd like to join. It's just a group of people getting together to chat about all these issues. Yeah, everything's pointing to inflation. Moving on to economics, I see that Nigeria and South Africa both exited recession in Q2. This is very much part of the BRICS, Brazil, Russia, India, China, South Africa, frontier markets, OBOR, One Belt, One Road, global initiative. In inflation, those countries are going to do very well. And of course, they're being helped amazingly, tremendously by the One Belt, One Road. Nigeria is absolutely fascinating. Within just a couple of years or a few years, do you know there will be 200 million residents of Nigeria? Isn't that amazing? And I think I'm right in saying the statistic that I saw is that by, it might have been 2030 or it might have been 2050, but it'll be the 4th largest population on the planet. So what would that be? That would be behind India, which will be the biggest, then China. So what would be the 3rd largest? I can't quite think. Brazil, maybe. Yeah, well, we'll come back to that. But Nigeria is going to be an absolute economic powerhouse pretty soon, actually. Pretty soon. Frontier markets, listener. In a similar vein, talking about inflation, look to see charts beside the pinned tweet of the show. And you saw, of course, there photos of New York on 8 11. This next chart is the Chinese yuan strengthening really quite dramatically since the end of last year against basically all currencies, but in this chart it's against the US dollar. The yuan has gone from about 6.9 to the dollar to just circa 6.5 to the dollar. That's a heck of a move in under a year. And, you know, some so intelligent macroeconomists and markets participants, they've just totally given up. Some of these names, some of you guys will know: Mark Hart, Kyle Bass, Burbank, Tepper, Crispin Odey. They've made massive positions going short the Chinese yuan. China's going to have to devalue 30, 40, 50%. They're going to make billions. Well, you know, they didn't. They've closed their positions. They've made big losses. I mean, some of the smartest hedge fund managers on the planet. There's a very interesting chart of Germany's house price index. House prices in Germany have gone up. Let me see if I can read this chart. They've gone up 50% since 2010. German house prices are up 50%. Now, bearing in mind, from 2003 to 2010, they fell 25-30%. But they've gone up 50% in 6 or 7 years. Now, you might think that's unremarkable, but no, again, it's because Germany basically runs Europe. And Germany is an economic powerhouse, while the rest of Europe is at best doing, 1 or 2% per annum growth? At best. So, absolutely fascinating. And I should just point out, although in aggregate German house prices are up 50%, some areas, I know particularly South Berlin, where they've built this absolutely mega airport, house prices have just gone up. Oh, it's just phenomenal. Inflation. Chinese producer prices index in 2012, minus 1.7%, 2013, minus 1.5%, 14, minus 0.9%, 15, minus 6.1%, 16, minus 2%. Producer prices fell year after year after year. 8 months into 2017, Chinese producer prices plus 6.3%. China's inflation is going crazy. And because their currency is strengthening so rapidly, China is exporting inflation to the West because we have to pay more to buy Chinese goods. China is exporting inflation to the West. Now, we'll come back to that. Let's look at the US dollar, which to my mind is the most important financial instrument on the planet. It's amazing how many other assets in effect revolve around the US dollar. Again, I remind you, as I've done in recent shows, the proof's in the pudding. If anyone questions this, go back and listen to my first shows in early March. And what I was saying there was that in public, I have been saying that the dollar, which had been strong for much of 2016, and indeed had broken out and broken up, should I say, above a very important horizontal resistance of a horizontal channel which had basically been there for 2 years. By early 17, or in fact might have been December 16, the dollar broke up. and the world and his oyster was massively bullish the US dollar. From January, I was saying the dollar is going to go down because that's what I was reading in the technical indicators. They were suggesting that the strength in the dollar was petering out. And, just because an asset is rising, it can still be that the strength is petering out. I mean, think of, for example, a firework. You get all this power pushing it up into the sky, and it's still rising, but you know that the power is ending. So it falls back down. And sure enough, as everybody knows, the dollar has totally crashed in the first several months of the year. And dollar net speculative short position now is the highest since 1999. In effect, everyone's short the US dollar. And one of my mantras is if everyone's looking one way, then the boys on Wall Street and in Canary Wharf are going to be coming at you the other way with a steam locomotive, and they'll run you over. The euro, which has had a very strong run, has got the highest long position in the market for years. Now, when the dollar goes up, basically the euro goes down, and vice versa, because the euro makes up 57% of the US dollar index, an index against the basket of major currencies. Similarly, the yen has been strong against the dollar, and when it is, it's amazing. There's a very high correlation to the yen strong against the dollar, the euro strong against the dollar, and gold and associated assets strong against the dollar. What did I tell you? The dollar has got the highest short position in nearly 20 years. Expect Wall Street to buy the dollar. Expect the dollar to rise. Expect the euro to fall. Expect the yen to fall. What does that mean to that other asset that I mentioned? Well, if you're leveraged long, I tweeted it today, the 11th of September 2017, you're toast. When I look at how far it can go down, I'm only taking it one step at a time. For example, Junior Miners Index is about 27 at the end of last week. I can see it going down to 23. So what's that? That's about a sixth or so, 15%. But if you're leveraged in junior miners 3 times, you're looking at a 50% fall in your holding. You don't want that. Now, an outlook for government bonds. What is very interesting to me and a little disturbing is the rising tide of global inflation. Global bonds, I'm telling you now, listener, could actually be on the verge of a generation of falls in prices. In other words, and therefore, a generation of rising interest rates. Literally now, this month, this quarter, we could be seeing the Wile E. Coyote look down when his legs were spinning and fall down the cliff. This could be the peak for 30 years in government bond prices and the trough, therefore, in global interest rates. Like 1982 was the trough in government bond prices and the peak in interest rates, which continued to last year, 34 years. And this is me telling you, I'm a guy who until early 16 was one of the biggest government bond bulls and interest rates bears in the world. Now on the other side, You've got some extremely smart and clued in and extremely well-researched guys. For example, Dr. Lacey Hunt. He's been all over this market for decades, and he remains, as many very, very smart people do, incredibly bullish. He's about the biggest bull in Christendom. It's a huge global fight in the markets, no question. You know, it's amazing. For 40 years or so, whenever there's been a downturn in the economy, global bond prices have risen, interest rates have fallen, so that has given the green light to central banks to reduce the base rate. You know what? Even if we were to go into recession 2018, 2019, it could still see higher interest rates. That is the most fascinating idea in the financial world. And it has validity. So I'm not saying I know the future, because I definitely don't. What I'm saying is there's inflation everywhere. And it seems to be sustaining, and it seems to be rising. That's all I'm saying. You need to consider very carefully what you're invested in. I've only got a couple of short quotes of the week, and then something else about on this day in history. The first one comes from the truly excellent Jacob Rees-Mogg, Conservative MP. Outside of the UK, you may not know that Rees-Mogg is a Conservative with a small c, a free marketer, anti-EU, anti-regulation, anti-bureaucracy, anti-big government. Great guy. He said, in relation to the EU demanding vast amounts of money from us, if a net beneficiary were to leave the EU, I don't think Michel Barnier would be pressing urgently for the EU to give them some money. Wonderful, wonderful. And the truly excellent Sir Mark O'Kine, he also made a fantastic quote. He said, "You are only supposed to blow the..." Oh, sorry, wrong quote. Up until I was 20, it's amazing. You think I'm him, don't you? I mean, it's true, isn't it? You can't, I mean, you get your eyes shut there and you think, my God, he's got Sir Michael Caine in the studio. Up until I was 20, I thought Luxembourg was a radio station. I didn't even know it was a country, and now he's running my country. And he doesn't seem to like us. Good on you, Michael Caine. Absolutely fantastic. And to wind up the show, on this day in history, well, not exactly, on the 9th of September, 1962, the Beatles recorded their first single, Love Me Do. Now, that reminds me of a cute marketing thing that I heard many, many years ago. And I'm going to try and remember it off by heart. And it's just come into my head. Something like this. 1 billion, was it minutes or 1 billion hours ago, Jesus Christ was creating a new way of living. 1 billion seconds ago, they were sending the first men to the moon. And 1 billion Cokes ago was yesterday. Isn't that brilliant? Listener, as ever, I have had a blast. Thank you so much for listening. Tweet me at Boomsbust Show. Email me, jd@theboomsandbustsshow.com. I will see you next week.